Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome to the Deep Dive. We are tackling, well, the billion-dollar question today, quite literally. When a massive company, think Fortune 100, decides it needs a serious injection of cash. The decision on how to raise it? Well, it's one of the most critical strategic choices they'll make.
It really is. It's that central dilemma in corporate finance, isn't it? Do you keep your funding private, deal just with banks, or do you go public and face the global capital markets?
Yeah.
That choice really shapes your strategy for years.
Absolutely. So our mission today is to give you that strategic map, help you navigate that core decision. When do you issue corporate bonds, and when do you run to the bank for a loan?
Right.
Because it's so much more complex than just finding the lowest interest rate. It's about control, timing, and crucially, how much risk you're willing to take on.
Okay, let's unpack this.
Exactly. You're essentially trading flexibility and speed, which bank loans definitely offer for the sheer scale and maybe the lower long-term cost of bonds.
But the second you choose bonds, you're basically volunteering for public scrutiny, ratings pressure, and, the sometimes unpredictable whims of market sentiment. That's the fundamental trade-off.
Okay, so let's start with the options themselves. Because the structure of the debt, well, it dictates pretty much everything that follows. We've essentially got three main paths companies take to raise debt capital. Path one, the traditional bank loan.
Right. This is your classic bilateral, often relationship-driven agreement. They're usually smaller in size and shorter in what we call tenor, the repayment time.
Okay.
They can be efficient, fast even. But the banks are lending based on trust and, close monitoring. So they put these operational rules in place, covenants, sometimes quite stringent ones.
Wait, okay, so if the bank gives you speed and maybe a favorable rate because you've been banking with them for ages,
Yeah,
you're basically treating that for less operational freedom. Is that right?
that's a good way to put it.
Like if your earnings dip just a bit, the bank could suddenly demand changes or even call the loan back sooner.
You nailed it. Covenants are kind of the price you pay for that relationship-based capital and, control.
Okay.
Then you scale up a bit to the syndicated loan. This is when you need a loan facility that's just too big for one bank to handle alone.
Okay, so group effort.
Exactly. A group of banks pools the money together. It spreads the risk across the lenders, which makes it suitable for really big-ticket financing. But it still functions essentially like a collective bank loan.
Yeah.
It's governed by private negotiations among that group, that syndicate.
Got it. And then the main event, maybe? Corporate bonds?
Yeah, the grand show, as you put it. This is where you step away from the banks entirely, or mostly, and pitch your company's story, your balance sheet, directly to investors in the public debt market.
Who are these investors? Like pension funds?
Pension funds, insurance companies, hedge funds, mutual funds, a whole range.
Yep.
But it's a totally different league.
Also.
It requires a lot more infrastructure on the company's part. You absolutely need a formal credit rating from agencies like Moody's or S&P. You need detailed regulatory filings, SEC filings in the U.S., and you need an ongoing investor relations effort to keep those bondholders informed.
Sounds like a lot more work.
It is. It's why that analogy works pretty well. Bank loans are like borrowing from that trusted friend you check in with all the time. Bonds are like pitching your entire financial life story out to the public, aiming for massive scale. So if that formality and public exposure are the cost of entry for bonds, that leads us straight to the gatekeepers, the credit ratings agencies.
Moody's, S&P, Fitch, those guys.
Exactly. And they don't just, assess risk in a vacuum. They fundamentally dictate the price of your capital in the bond market.
Okay, so it's basically the difference between getting cheap money and getting expensive money. You mentioned investment-grade issuers. What's that mean exactly?
Investment grade means companies rated BBB or Boss 3, depending on the agency, or higher. They're seen as the safest bets. And because of that perceived safety, they enjoy access to enormous pools of capital-think pension funds that are required to hold safe assets, often at the lowest available rates.
And the flip side.
The flip side is high yield, often called junk bonds, though the industry prefers high yield.
All right.
If your rating dips below that investment grade threshold, suddenly the pool of potential investors shrinks dramatically. And the cost of borrowing, the interest rate you have to pay, it skyrockets. You're paying a huge premium for that perceived higher risk.
But sometimes companies have to go there.
Oh, absolutely. For many growing companies, or maybe firms carrying a lot of debt already, that high yield door might be the only way they can access the sheer scale of capital needed for major projects or acquisitions, even if it costs more.
Okay, this pivot point feels really crucial. Timing and opportunity. Market conditions.
Hugely important.
Like you mentioned low-rate environments, the
Yeah.
2010s, for example. What happened then?
Well, you saw this incredible rush. Companies were falling over themselves to issue super cheap long-term debt. Why wouldn't you lock in low rates for 10, 20, even 30 years?
Makes sense. Any
Yeah.
examples jump out?
Microsoft is a great one from around 2020. Even though they were sitting on mountains of cash, they issued these multi-tranche corporate bonds at historically low interest rates.
Why? Just because it was cheap.
Partly, yes,
Uh-huh.
but primarily to strengthen liquidity during the uncertainty of the pandemic. It was a strategic, opportunistic move because the capital was effectively almost free money at that point. Smart treasury management.
Right. So that's when rates are low. What about now, or say post-2022 when rates started climbing?
Well, that strategic flexibility starts to disappear pretty quickly. Bond issuance tends to slow dramatically because the cost just becomes prohibitive for many.
So they're forced back towards the banks.
Often, yes. They lean more heavily on bank financing, like revolving credit lines or new term loans. And this is where that relationship factor really pays dividends.
The relationship thing again.
Yeah. Your long-term bankers, they might still be willing to lend to you, especially if you're a loyal, long-standing client, even when the public bond markets completely seize up because of rate hikes or, some kind of market panic. That relationship provides a buffer.
Okay, so let's dig into why a company might actively choose bonds over loans, even if they could get a bank loan. It sounds like sometimes it's about unique strategic needs, or maybe just sheer scale that banks can't handle.
Exactly. Strategy is often key. Take Apple, for instance, back in the 2010s.
Right, they always have tons of cash, don't they?
Exactly. They were sitting on these massive cash reserves, hundreds of billions. But here's the catch. The bulk of that money was generated and held overseas.
And bringing it back to the U.S. meant?
Billions in repatriation taxes under the old tax code. A huge tax bill.
Okay, so what did they do?
The Treasury team made a really clever move. They issued over $100 billion in domestic bonds instead of bringing the cash home.
Wow, so they borrowed money even though they had cash.
Precisely. The bonds provided a super tax-efficient, very low-cost way to fund things like share buybacks and dividends for their U.S. shareholders without triggering those repatriation taxes on the foreign cash pile.
So the takeaway isn't just they needed cash, it's that debt was the smartest tool for a specific tax-driven problem.
You got it. It was a financial engineering solution. Now, contrast that with someone like Tesla, especially in their earlier scaling phase.
Right, when they were building gigafactories and still weren't consistently profitable.
Exactly. Traditional banks, which are often governed by stricter lending guidelines and look closely at current profitability, were probably quite cautious, offering Tesla the massive long-term funding needed for that kind of expansion. That felt risky to a bank.
So where did Tesla turn?
They tapped the high-yield bond market.
The junk bond market.
Well, high yield, yes. The cost was significantly higher, no doubt about it. But that market attracted investors who were willing to bet on the future potential, the exponential growth story, rather than just the current profit and loss statement.
So that higher cost capital was actually critical for them.
Absolutely critical. It let them access the scale of funding when more conservative, traditional lenders probably wouldn't step up to that degree. It fueled the growth narrative.
And then there's just pure size.
Well, pure size. Look at AT&T when they decided to buy Time Warner. That was a colossal deal.
Huge.
To finance that acquisition, AT&T became one of the largest corporate bond issuers in the world. We're talking tens and tens of billions in bonds.
Could banks even have handled that?
Not easily on their own, maybe a massive syndicated loan, but for that kind of global level strategic M&A, the public bond market is often the only place deep enough to find the necessary, frankly, trillions in aggregate capital available. It just illustrates the scale the bond market offers, but also the immense risk you take on with that much debt.
Okay, so it feels like bonds are often for these huge strategic plays, maybe when money's cheap, or for unique situations like Apple's tax issue. So when do loans, especially those big syndicated loans, become the go-to choice, even for healthy giants?
Yeah, good question. It often comes down to speed, flexibility, and what happens when, well, panic hits the market.
Crisis mode.
Crisis mode. The COVID-19 downturns are just perfect examples. Think about Delta Airlines early in the pandemic.
Oh yeah, airlines got hammered.
Hammer doesn't even cover it. Air traffic down 90% almost overnight. Public bond investors, they were completely spooked. The whole airline sector looked incredibly risky, solvency questions everywhere.
So Delta needed cash like yesterday.
Exactly. They needed liquidity immediately. Trying to arrange and sell a public bond issue in that kind of environment, forget it. It would have been incredibly slow, maybe impossible, or just prohibitively expensive because the market had basically seized up for airlines.
And what did they do? Loans.
They pivoted very quickly to syndicated loans and also utilized government-backed credit facilities that became available. The loan structure allowed them to move fast, negotiate terms privately with lenders who understood the, frankly, distressed situation.
So flexibility and immediate access were more important than getting the absolute lowest rate.
Completely. Speed and certainty trumped optics and even cost in that moment.
We saw something similar with Ford Motor Company too, right? During that same period.
Very similar playbook. When auto sales just collapsed temporarily, Ford drew down heavily on its existing revolving credit facilities. Those are pre-agreed lines of credit with banks.
Like a corporate credit card almost?
Sort of, yeah, but much bigger and more structured. They also secured new syndicated loans in 2020. That existing bank relationship, those committed credit lines, acted as an absolutely essential safety net. It provided the liquidity to keep operating when revenues just vanished overnight.
It shows the value of maintaining those bank relationships.
Absolutely. And then you have complex cases like Occidental Petroleum. They used a staggering amount of debt, a mix, actually, both huge bank facilities and bonds to fund their massive acquisition of Anadarko back in 2019.
Using both tools.
Right, integrating both pools of capital to hit this enormous funding target. But then, the oil price collapsed not long after. Yeah, and it really demonstrated how quickly that huge integrated debt load financed through both channels could become incredibly toxic under pressure, led to severe pressure from shareholders, asset sales. A really tough situation. It shows the risks of leveraging up that much, regardless of the source.
So, pulling back a bit, when we look at all these choices, bonds, loans, the mix, what's the core lesson when the market turns or maybe the company's strategy doesn't pan out? You said debt accelerates growth?
Yeah.
Does it also accelerate collapse?
That's precisely the point you have to remember. Debt is an amplifier. It magnifies outcomes, both good and bad.
All right.
If your underlying business, your fundamentals are strong, debt can absolutely turbocharge growth, fund expansion, boost returns.
Yeah.
But if those fundamentals are weak or become weak, that same leverage accelerates the decline, often exponentially.
Can you give us an example of that amplification going wrong?
Oh, the textbook case, sadly, is Toys R Us.
Yeah. What really happened there? Was it just Amazon?
E-commerce competition was definitely a huge factor, no doubt. But the company wasn't just killed by online rivals. It was ultimately suffocated by the sheer mountain of debt, particularly leveraged loans that were placed upon it during its time under private equity ownership.
Okay, so the debt itself is the killer.
It was the critical vulnerability. As their profit margins got squeezed by the competition, the core business simply couldn't generate enough cash to service those aggressive debt payments and meet the loan covenants. The takeaway isn't necessarily that the business itself was doomed from the start. Maybe it could have adapted. But under that specific, very heavy capital structure, the debt load and its strict requirements just became unsustainable. Bankruptcy was almost inevitable at that point.
Wow. Any other examples spring to mind?
Well, think about WeWork more recently. Their incredibly aggressive global expansion was heavily fueled by debt alongside equity.
Right. They raised billions, but also borrowed a lot.
Exactly. And when their underlying business model, their path to profitability, and their corporate governance all came under intense scrutiny, well, those projections proved shaky. And that extreme debt exposure left them incredibly vulnerable when the market sentiment turned and new funding dried up.
So it's a painful reminder that how you finance the company isn't separate from the operations.
Not at all. Capital structure risk is ultimately operational risk. Too much debt or the wrong kind of debt can cripple even a potentially viable business.
Okay, this brings us to the really crucial part for you listening. Maybe you're a finance professional. Maybe you're just interested in business strategy. Given these competing forces, flexibility, cost, scale, market access, risk races. How do you actually build a decision framework? How do you engineer resilience into your financing choices?
Yeah, that's the key question. You absolutely need to move beyond just a simple cost comparison, like bond A is 5 basis points cheaper than loan B. It's about the structure's ability to survive a downturn. We generally use about 5 crucial questions to help determine the right choice or the better choice between bonds and loans in a specific situation.
Okay, let's hear them.
Question 1. Question 1 is the obvious one, but foundational: cost. What is the true all-in cost? That includes not just the interest rate, but also upfront fees, bank fees, legal fees, rating agency fees, the ongoing cost of regulatory compliance and investor relations if you're issuing public bonds.
Right.
Get the total cost picture.
Not just the coupon rate. Okay, question 2.
Question 2 is maybe even more vital, and certainly in tough times. Flexibility. How restrictive are those covenants we talked about?
The operational rules.
Exactly. Are you potentially tying your company's hands operationally just to save a tiny fraction of a percentage point on the interest rate? Those covenants often determine whether you have wiggle room, the maneuvering space you need to pivot, or just survive during an economic downturn. Don't underestimate their impact.
Okay, flexibility. Got it. Question 3.
Question 3, market access. Be realistic. Right now, today, is there genuine investor appetite for your company's specific credit profile in this market? Can you actually get the scale you need and on reasonable terms through public bonds? Or are you perhaps better off relying on your established bank relationships that might provide more certainty, even if it costs a bit more?
So, assessing the market's mood for your specific company.
Precisely. Question 4 addresses a bigger picture, the macro environment. Timing. Are the overall conditions, think current interest rates, inflation expectations, recession feels, general market volatility, are they actually favorable for locking in long-term bond financing right now? Or does it make more sense to use shorter-term, perhaps more flexible bank credit that you can adjust more easily if conditions change?
Makes sense.
Okay.
Aligning with the economic cycle. And the final question, number 5.
The final really strategic question is strategic fit. Does the financing actually align with what you're using the money for? For example, are you funding a massive 30-year infrastructure project with debt that needs to be constantly refinanced every 2 or 3 years? That's a huge mismatch, introduces unnecessary risk.
So the term and structure of the debt should match the life and risk of the asset or project being funded.
Ideally, yes. You want alignment. And critically, beyond these 5 questions, you must stress test whatever path you choose.
A stress test.
Don't just model the best-case scenario where everything goes right. Model the downsides. Ask the tough questions. Can we still refinance this bond if interest rates spike 300 basis points, 3% higher than today? Can we still meet our loan covenants if our earnings, our EBITDA, fall by 20 or 25% next year?
Planning for the worst, hoping for the best.
Pretty much. The most successful finance teams, the truly strategic CFOs, they don't just focus on raising capital efficiently today. They engineer a capital structure that's robust, that can withstand multiple foreseeable and even some unforeseeable economic shocks down the road. Resilience is the goal. #outro.
Well, what's really clear from all this is that whether you're, say, a fast-growing tech company needing that high-yield capital to scale, or maybe a massive blue-chip firm looking for the most tax-efficient way to return cash to shareholders, these financing choices are just intensely contextual. It really depends entirely on the market mood at the time and, of course, the strength of your own balance sheet.
And that context, as you say, is absolutely everything, because the financing choice you make today, it isn't just about tweaking the current P&L or getting the lowest rate this quarter. It fundamentally shapes your company's future capital structure, its financial flexibility, and its overall ability to withstand the next crisis, whatever that crisis might be.
A sobering thought.
It is. So the final thought maybe to leave you with is this. Focus on building resilience through your financing strategy, not just on raising capital at the lowest possible immediate cost. That long-term resilience is what truly creates value. Until next time, stay sharp, stay strategic, and keep leading with clarity.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.